So, appreciate you bearing with me there through part one, and looking forward to Q&A if there's anything I can kind of re-clarify. But I do want to move on to evaluate those things. So let me restate for you what my agenda is here in the talk before I introduce today our real main event in the address you're going to hear from Dr. Morse. I want to identify today the false scapegoats of causing the crisis. I want to identify the true causes of causing the crisis. I want to really evaluate the societal causes that I think are equally important to policy causes, look at the bad solutions we've dealt with ever since, and then briefly outline what I deem to be a beneficial path forward. But I talked earlier about a lot of these issues with the bailouts and the things that took place with the Wall Street firms and so forth and so on. And it's important today that I make this much clearer as we move along. I'm not here to lament TARP nearly as much as I am the decisions, policies, and developments that led up to it. That's different than saying I support TARP or don't support TARP. I really desire for my conservative brethren to just be a bit more nuanced and sophisticated in how we're approaching this. It is, for all practical purposes, at this point irrelevant about that specific vote, that specific day. What is not irrelevant is the massive amount of things that had to go wrong to lead to it all at once. And I think that those are the things still very much at play. I always appreciate hearing folks blast the Wall Street bailouts, especially people who voted for them, like Barack Obama. But my focus today is on what challenges should be pursued that would make another TARP fully unnecessary. But I will quote Kevin Williamson from National Review. We ought to live in a country in which a solution to the crisis that is consistent with the best of our values has a chance of being enacted. But we didn't. But let's talk rather than, or at this point, rather than get into the solution that was put out in that fateful day of October 2008, but let's talk about the scapegoats and things that have been mentioned. And in each of these cases, I'll try to be specific if I'm referring to the fact that these are false altogether or false simply because they're incomplete. But these are common things thrown out there regarding the crisis that I want to bring up. Some may just seem very insignificant to you, inconsequential, and I ask you to just forgive me because I'm only mentioning them if there is not some audience out there in the public square that has devoted a lot of time to it. And so one of these, I imagine, may scratch your particular itch on it. If there's any possible way, too, I could get somebody to close that door in the back. I have my reasons. Okay. So I talked earlier about this Glass-Steagall Act and this bill that sort of broke up the big investment banks. And one of the things that's become extremely common, so embedded into the orthodoxy of this conversation that right and left let it slide without any mention whatsoever, is that the 1999 repeal of Glass-Steagall really laid the framework for this awful crisis. It's actually not a horribly bad thing that they're blaming the repeal of Glass-Steagall because it at least is bipartisan or apolitical. Yes, a Republican, Phil Gramm, authorized the legislation, but a Democrat, Bill Clinton, signed it into law. Probably people harping on this Glass-Steagall issue are not totally partisan-driven, which is a good thing in this. But my problem with it is, first of all, just for those of us that actually care about truth, it is a blatant lie. There is absolutely no proof whatsoever that any of the investment banks participating in decisions that proved to be perilous were doing so with depositor funds. There wasn't a single Wall Street investment bank of the ones that got themselves into trouble that got in trouble with customer money. They got in trouble with their own money, which was just as bad as we ended up finding out. We'll get to that. But my point is the repeal of Glass-Steagall did nothing. If anything, the banks and financial institutions that were first most damaged by the financial crisis, either because they were causing it or then the effects of it were hitting them, had nothing to do with legislation relevant to Glass-Steagall. Fannie Mae, Freddie Mac, AIG, Bear Stearns. Bear Stearns did not participate in retail banking. Bear Stearns was the first big Wall Street firm to go down. You couldn't walk into a Bear branch, make a deposit, and then a Bear go out and lever your deposit 45-1 and buy toxic mortgage debt with it. But that's what you would believe happened if you hear this absolutely accepted orthodoxy, which is either purposely or even equally damaging, just out of ignorance, being promulgated upon people. Now, forgive me real quick. I changed a setting in my iPad notes, and it's going to keep blanking out on me if I don't fix it. Okay. So the point I'm making is that this notion of the repeal of Glass-Steagall causing the problem is untrue. Let's move on to another one. How many of you have seen the movie Blind Side, maybe Moneyball? Both of these were based on books written by an author named Michael Lewis. He's one of my favorite authors. Absolutely love his ability to write a captivating book. The first one he ever wrote that made him a famous and wealthy man was a book that came out in 1989 called Liar's Poker. And it is absolutely fantastic book about his life as a bond trader at Solomon Brothers Investment Bank. And then it made him famous, and he took off in a career as a writer. And he wrote a book called The Big Short. And he's a frequent writer in Vanity Fair as well, and so forth. And in all honesty, I'm complimenting him as a writer, and I'm not critiquing him right now because he happens to be a left-wing ideologue, although he is. But his whole thesis is what really brought us all down is the day the big Wall Street firms decided to become publicly held corporations instead of privately held partnerships. And there's, just like this repeal of Glass-Steagall, there's a certain rhetorical nicety to it. There's a prima facie kind of acceptability that, well, yeah, all of a sudden they're publicly held, it's shareholder money, so they could just throw these big, big risks out there and not care, whereas back when they were private partnerships, then they were much more responsible because it was their own money. And so I think that sounds pretty good, except for it's just totally untrue. And he knows it, because Lewis is not a dumb guy. It's said for rhetorical benefit. Do you have any idea how many private partnership Wall Street firms blew themselves up before they started going public? People are capable of being very stupid and very greedy in all sorts of legal structures. And what brought these Wall Street firms to their knees, their recklessness with balance sheet, was all money they had borrowed anyways. It was they were all capable of issuing bond debt, whether they were private partnerships or public corporations. The thing that is being missed, though, in this analysis that is so important is there's no vindication of Wall Street here. It's just a simple question. If what was really wrong was the fact that they were set up as publicly held corporations, then why was it only financial institutions that were blowing up with excessive risk? Why don't we see that across all forms of publicly held companies? Because, hey, it's no longer our money. It's shareholder money. We can take big risks. So why don't we see that with all the industrials, consumer companies, all other categories of organizations that happen to be publicly traded on the stock exchange? The reality is that we know that incentives were wrong, but what Lewis has done is give a convenient way to summarize wrong incentive, and I think he misses the point. The third issue here, and now I'm going to kind of turn the gun a little bit on a lot of my friends on the right. I think that in this case, the vast majority of the time I hear this explanation offered, I actually think it is well-meaning, and I think they're just wrong. Sometimes it probably is being said just for convenient rhetoric, which is equally wrong. This is the notion that the Community Reinvestment Act of 1977 forced all of this subprime lending, and that's really what brought the world to its knees. What depresses me about this is that they are sacrificing a very legitimate close point for the sake of a slightly easier, more flowery false point. I'll argue in a moment that Fannie and Freddie were at the very heart of this crisis, but not because of subprime buying, which didn't even begin at Fannie and Freddie until late 2004, and even then was a minuscule part of their balance sheet. The Community Reinvestment Act was a silly piece of legislation. The Clinton administration's anting up of it was certainly a part of the environment but again, really very, I think, ignorant to try to portray the whole crisis as being caused by that. Real quickly on this one, the common theme that's come up is that short sellers were driving the whole thing. And again, I talked earlier, short seller is somebody who sells an investment they don't own and then wants to buy it back at a lower price. And I would agree with a lot of my friends on the point that if we don't believe there's a powerful short-selling lobby, not just a group of investors, but really a group of political activists in this country, I think we're wrong. I think that there is a very dangerous sense in which guys are attempting to make things become true by betting against them. But it's also got to be said that short sellers oftentimes provide a lot of transparency to a market. In and of itself, somebody has a right to bet on a thesis and either be wrong or right. What they don't have a right to do, of course, is bet on a thesis and then work to manipulate to make it right. But the idea that the short sellers themselves, it's very similar, by the way, although the reverse side of the trade, to this idiotic rhetoric about speculators driving oil prices up. Why would a speculator, if oil prices fundamentally belong down, risk so much to try to bid them up when inevitably they're going to lose on the trade? They can only be successful in speculating on it going up if there's some prima facie fundamental basis for the viewpoint. A short seller is taking an off. There's no limit to how much a short seller can lose. Whatever they bet on going down can go higher and higher and higher and higher, and they keep losing. Why would they do that unless they had some degree? Now, in a lot of cases, there's manipulation and fraud, both of which are already against the law. But I don't believe that in and of itself, a short seller can cause something to be true. I think it goes against a lot of people's natural impulse. I remember after 9/11, Bill O'Reilly on Fox was real critical of those who were shorting the market. And he said it was unpatriotic. I don't know. It's not in my DNA necessarily to necessarily like going about betting against things, but the reality is it's certainly legal and can hardly be can be labeled causative. The fifth element I'm going to quickly hit is this notion of executive compensation. These guys were paid so well, they had all incentive to just boost their bonuses and didn't care about anything else. A lot of which it might be pretty true. I would say that management boards and compensation committees were I don't know, I think across the board, pretty reckless and irresponsible, but to label that as part of causing the problem doesn't make a whole lot of sense. Lehman Brothers went from $66 a share to $0 a share. The number one largest shareholder in all of Lehman Brothers the day they went down was their CEO, Dick Fuld. Now, granted, he was a wealthy guy, but I promise you, I work with a lot of very wealthy people. They don't, just because they already have their mortgage paid, like losing $1 billion, okay? It is very disillusioning for people to learn that sometimes the smartest people in the world are not as evil as they are just stupid. And I'm telling you that Bear Stearns, by the way, you had Jimmy Kane, who ended up selling all of his Bear stock and getting $50-60 million out of the deal total. Had not been selling the whole way up and down like a lot of the other guys were. And of course, I don't know very many people that cry over $50-60 million, but Jimmy's position was worth over $1 billion. So you have plenty of people that they themselves had their net worth decimated. That's not to make a moral defense of anything they did. It's to simply say it wasn't that the incentive there was off. They were just literally making bad decisions. But I think executive compensation concerns play into the most natural impulse in the political environment, which is to generate a class envy. And again, this dovetails with that, but the investment banks' conflicts of interest. We've talked a lot in the press over the last few years about these big Wall Street firms that were betting against housing, but then they were selling these pieces to other investors and so forth. And the analogy I came up with is criticizing financial firms for having one division selling something, another division buying it, is like criticizing McDonald's for selling Big Macs while simultaneously selling salad. After all, this is seemingly a contradictory view, unless you're one of those many people that says at the drive-thru, I'd like to have a salad and a Big Mac. But I don't think very many people do that. But what they're doing is offering something to two different types of people. Is this complicated to anyone? Are you with me so far? Some people like salad, some people like Big Macs. Some people wanted to buy an asset, some wanted to sell it. They're in the business of manufacturing a financial product. And it was, we're not talking about people that were going to mom and pop investors and grandma trying to convince them of something. This is large, huge institutional investors buying these kind of packaged mortgage products, and we're told that the investment banks have these big conflicts of interest. And the vast majority of people making this criticism do know better. It's an irrational and misguided investment. But again, it comes down to this other tension I think exists. For some reason, we take more comfort in believing that there's callous and greedy masters of the universe that are kind of doing these things, rather than accepting the somewhat uncomforting thought that a lot of these people are really not as bright as we made them out to be. So those are all examples of certain minor parts that come up a lot of times in the various narratives. But if I could summarize the big picture of what I'm here to critique today, it's going to be like this. For the most part, the left is going to tell you that the financial crisis was a byproduct of greed and unbridled capitalism that was unsatisfactory or regulated, and that the evils of Wall Street brought the world to its knees. And I'm going to tell you that that's wrong. But unfortunately, the right is also going to offer an equally simplistic narrative that is, to a certain degree, right, but also incomplete. And that is that these government agencies wanting to use housing as social policy set up an environment that then it all blew up and we had the big financial crisis. Both what the left says and the right says have kernels of truth to them. And I would probably argue the right maybe has a bit more, although that's hard to quantify. But what both of them do really wrong is not in anything they do say. It's in a huge piece of this story that they don't say. And hopefully today I'll lay it out there in such a way that it might change your way of thinking a little bit, or at least cause you to consider it a little more exhaustively. So if I were to lay out a list of things that I consider to be the true causes of the crisis, I'm perfectly happy to start with Fannie and Freddie, but not necessarily because they were out doing a bunch of subprime lending. It just isn't true. That isn't what Fannie and Freddie were there to do. But it's worse than that. Fannie and Freddie served as the massive price distorter in the entire housing market, not because of subprime commitments, but because of the real evil of Fannie and Freddie, the implicit government guarantee. Those that want to tap the capital markets, want to go get an investment that will pay them a rate of interest, can go to the United States government, buy a treasury bond, and have the full faith and credit of the United States government backing it. They also have a printing press. They have taxing authority. People feel very confident that they'll get paid back when they buy a treasury. It generally, a treasury bond, a treasury bill, a treasury note. It generally would have the lowest rate of interest offered because it has the highest degree of safety. Then they could go to a very risky vehicle, and then there's everything out in between. Fannie Freddie were hugging right up there next to the treasuries. They offered a little bit more interest than treasuries, but way less interest than these kind of riskier corporates. Fannie and Freddie, in other words, were able to tap the capital markets. Investors all over the world would lend them money because they had the implicit guarantee of the government. But the implicit guarantee of the government was clearly explicit, as we found out in September of 2008. So that $5 trillion of indebtedness is essentially now on the balance sheet of the United States government. I would argue that $4.5 trillion of that is money good, $500 billion of it's money bad. It doesn't exist, by the way, on the real balance sheet. They keep it in conservatorship, so it is not technically an asset or liability, but it's functionally an asset liability. What this did, though, that really trickled down into the housing market is virtually all good loans were sold off to Fannie Freddie. They had good lending standards. They had a limited amount they were willing to borrow. Banks could bring in, they could originate loans, sell off to Fannie and Freddie, and have their capital available to do more lending. In theory, so far, not that bad of a deal. But this is the thing that was never, ever understood, or worse, some of the politicians didn't care. The problem, of course, is that Fannie and Freddie's ability to buy that volume of loans, And keep in mind, just assume these are all good loans. For the most part, they were. The problem is that they were only able to borrow that volume of loans, which freed up banks to do more loans, because they were able to raise so much money for such a cheap borrowing cost. They were only able to raise so much money at such a cheap borrowing cost because of the implicit government guarantee. It still all came down to the moral hazard of the fact that all the times China was buying hundreds of billions of this stuff, and all of us buying Fannie and Freddie bonds and so forth, saying, hey, it's like a treasury, but we're getting a little bit more money. It was still done on the back of a guarantee that distorted the price signal. It was inaccurate. And what happened, and then, by the way, at the low cost of borrowing money, they were allowed to lever their own balance sheet up 30 times, equaling Wall Street levels of leverage, all under the moniker of being a, quote, government-sponsored enterprise. For 30 years, nobody ever defined what this meant. Nobody ever cared. I would argue that what we experienced was largely just simply, finally, the balloon bursting after getting filled with way too much water. Number two. Okay, a lot of you, there's a good portion here in the room I don't know personally and so forth, but please don't, if you're a fan of Ron Paul politically, don't take offense at this, and in a second you're going to be maybe even kind of pleased. But a lot of you in the room who do know, I've been a bit of a public critic of Ron Paul, and I have pretty good reasons for that. A lot of them focus on differences I have with him in foreign policy. The bulk of them deal with differences I have with him in tactic and how we go about generating some societal change, some of his affiliations. Okay, so yeah, I understand for those of you in the room that know I haven't been a huge Ron Paul fan. But I have to be capable of giving some credit where credit's due. When someone's wrong in one thing, it doesn't make them wrong in everything. And my analogy here, speaking of McDonald's and the Big Mac, I don't really like the Big Mac and McDonald's very much. But every holiday season, when they bring the McRib back, I'm there. I think Ron Paul has foreign policy deathly wrong. And I think a lot of the way he articulates monetary policy, he gets wrong. I certainly think, by the way, the notion of how they want to go about getting to sound money is irrational. But I agree with him on this very much. An insane interest rate policy under Alan Greenspan from 2001 to 2005 caused the housing crisis. It caused the financial bubble. There would be no financial bubble without the behavior of the Federal Reserve from 2001 to 2005. Now, the reality is that the dot-com crash I alluded to in my prior talk set the tone for why they believed it was necessary. At some point in time, Bill Fleckenstein wrote a book about Greenspan's bubbles. Greenspan became ideologically committed to the notion that it was the job of the Fed to deal with the aftermath of asset bubbles. I don't agree with that. I don't agree that his objective is to neuter the damage done from bubbles that blow. But Greenspan believed sincerely, in my estimation, that was his job, and went about trying to do so. And I think in the process of neutering the damage from the dot-com blow-up, really created a far, far bigger blow-up in what became the housing crisis of 2008. A monetary policy that seeks to cure all economic woes through the manipulation of interest rates leads to perpetual boom-bust cycles. That isn't very complicated. And a lot of people in the Austrian economic camp could say that, but so could others in different economic worldviews as well. But it is indisputable. The manipulation of interest rates set the tone for what the financial crisis would end up being. Number three, price distortion leads to undesirable activity. Hayek taught us this, and I think that we need a massive review of Friedrich Hayek and the American school system. The price distortion that leads to undesirable activity is exploited by economic actors. Wall Street was late to this party, believe it or not, but they were no exception. There was a glut of money sloshing around the world. Wall Street's job was to find a home for it and do so in the lowest yielding environment of all time. Interest rates, and this 1% era of when all this crisis and housing bubble was forming, were the lowest they had been. It was a perfect way for the Wall Street firms to lever up their return on equity, fatten their P&Ls, meet investor demand, generate fees, and increase value on their own balance sheet. And enough demand existed to distribute this stuff all over the world, as well as loading up their own balance sheets with it. But the question we have to ask is not why greedy bankers would act like greedy bankers. Greedy bankers act like greedy bankers because they're greedy bankers. Why was there so much demand out there? Why was there the craving for such a supply of product? And that's what we're trying to argue, is that the monetary environment, Fannie Freddie environment, combined with some of the other housing things we'll get to in a second, set this up. Chuck Prince was the CEO of Citigroup. He was largely criticized. I think it was in 2007 he said that when you're at the dance, everyone's dancing, you got to get up and dance. And he was trying to explain why Citi had levered up their balance sheet so much like these other firms did. And everyone said, well, that's so reckless, irresponsible, which I think it was, but there's a problem. He's completely, totally right. I mean, people can say whatever they want in their self-righteous indignation of these CEOs that they didn't, see a little bit more in advance what was going on. But it just does not matter if you think that. In 2004, 2005, 2006, if somebody on Wall Street had the courage to say, this is a bubble, we got to get off this train, and they went down to 11% ROEs when their competitors had 40% ROEs, they would have lost their job in 5 days. There is no possibility that when everybody was in the dancing that somebody was going to decide to stop dancing. Now, I'm not necessarily saying this prescriptively. I'm saying it descriptively. What I think we have to evaluate, though, is why that was. Why were they all participating in this hysteria? Number 4, the March 2008 bear bailout illustrated a 30-year secret of government, Wall Street, and capital markets. The government will do anything to protect bondholders. The secret protected class in our society is creditors. Borrow, 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 moral hazard abounds. Even in the fall 2008, besides Lehman, the sacrificial lamb, not one bondholder of one firm took 1 penny of a haircut. Fannie Freddie, it amounts to trillions of dollars. It's happening right now in Europe. Besides, now they just had this Greece haircut, right? But clearly there's insolvent countries, and they're going through these bond buying and all these gymnastics, and there's perfectly good arguments within their paradigm, which I fully disagree with, for why they're doing it. But the reality is none of it's necessary if they would simply say to bondholders, you took a risk, you lost, you're not getting paid everything. If you go out and loan money right now to Rite Aid, kind of a troubled pharmacist, drugstore type company, they're in a lot of trouble. You might buy one of their bonds for 60 cents on the dollar. I don't think you're going to get all your money back, and the market's telling you that. But then you're going to get a big rate of interest, so you take a risk. But the issue with all of these other categories is they won't do it. They won't treat lending money to troubled institutions as if it were like loaning money to Rite Aid. They protect creditors at all costs, other than when there's a political interest not to. The issue is that, to be perfectly honest, if we were allow healthy markets with price discovery, as Hayek talked about, function where bondholders took risks, bondholders would demand greater interest than they're receiving. And that's what they're trying to avoid. They're trying to avoid real price discovery and the cost of money. It's been the 30-year crusade. So the truth is, whether it's sovereign debt in European countries or whether it's the bonds issued by Fannie, Freddie, or even Wall Street firms, this obsession with creditor money coming back, other than when it's politically expedient. So the bondholders of GM could be a sacrificial lamb. The bondholders of Lehman obviously were allowed to suffer. But everybody talks, with good reason rhetorically, about the bailouts of the firms. But here's who really was bailed out: bondholders and depositors. Nobody in this country who had money on deposit with Lehman Brothers lost a single dollar, or Bear. Nobody lost a dollar if they were fully invested in a bond of all these different troubled financial firms. However, the exception is little things like GM, which was an insignificant amount of money in the grand scheme of things. And of course, in that case, it was an issue of putting the labor unions ahead of the bondholders. But I think that this notion of trying so hard to force interest rates down to stimulate economic activity is a classic case of price discovery run amok. There is no ability to know what it's really worth in this society to loan someone money or to borrow money. And so therefore, it leads to all kinds of irrational and ultimately dangerous economic behavior. Please feel free to ask me for clarification because I went through it quickly, but it's an important point. Number 5, this issue regarding mark-to-market accounting. I'd refer you to Brian Wesbury's book on the subject. Steve Forbes, by the way, has written a lot of very good things about this. And that is the probably well-intentioned piece of legislation, the aforementioned FASB 157, requiring firms that whatever the last trade was done on a given investment piece, so if there's a bundle of 1,000 mortgages, it's sold as one bond, and someone has desperately got to sell, there's barely any market for it, they sell it for 70 cents on the dollar. Not one single mortgage in the entire pool is defaulted, not one missed payment, but there's just no buyers. There's a kind of proverbial fire going on in the neighborhood. And then all the other firms had to mark down the value of that bond that they hold to 70 cents, forcing massive capital problems across the firms. Like everything I've mentioned so far, mark-to-market was not adequate in and of itself to have caused the crisis. But it is absolutely inexplicable why it hasn't gotten more play. Why is a Wheaton economist in Chicago the only guy I've really heard talk about it? Steve Forbes talked about it a little bit. But this is a major issue, but it doesn't meet a political narrative from the right or the left. It doesn't bash government, housing, Fannie Freddie. It doesn't bash Wall Street. Yet it is a very sensible and important part of the conversation. But this is the point then that I'm kind of leading to regarding all these things. Fannie, Freddie, Wall Street, price signal, interest rates, monetary policy, all of these things that were off. It doesn't work to lay out a mere enumeration of causes because that list will inevitably fail to capture the interdependence of all the items on the list. We can say government using housing as social policy and we'd be right. We can say Wall Street took on too much leverage, we'd be right. But my underlying thesis is that each side of the political divide is merely taking their most hated institution and casting all blame there, rather than seeing the perfect storm nature of this crisis. Wall Street excesses, bad government policies, bad Federal Reserve monetary policy, all had to be there. And now I'm going to start my talk. Because then a greedy, reckless, irresponsible, covetous, insane Main Street had to exist, had to light the fire of this financial destruction. This, my friends, is the most politically unacceptable thing to say, that in reality, this wasn't a government crisis or a Wall Street crisis, but was a Main Street crisis. The narratives floating out there are false if they're seeking to vindicate those who actually themselves caused the crisis. Now, Andrew this morning actually did an outstanding job alluding to the fact that it is highly selective and unfair to refer to the greed of the Wall Street CEO, but ignore the greed of the person who bought the home he knew he couldn't pay for and things like that. But keep in mind, 40-to-1 leverage will work forever and ever as long as it never ticks down, and as long as everyone makes their payment, it never ticks down. Now, we did not have a housing crisis because of those normal, understood, acceptable part of the formula defaults. We had the crisis because of the wave of defaults. So for my purposes, because I absolutely will not tolerate people taking what I'm saying right now, when I say won't tolerate, it would really upset me for people to hear me right now as saying that those really unfortunate cases were all their own fault and forget them, they caused the mess. I'm referring by what I said. I mean it. Main Street, the masses, not those isolated outlier cases that are real unfortunate. I've talked about this a few times over the years. I sat at a very prestigious hedge fund manager's office in New York in September of 2010, and I will never forget the kind of chill I got when they said, and this wasn't a person who believes in the free and virtuous society necessarily. They weren't coming at it with either the religious or the political presuppositions that I do. But they said to me, the reason why the world didn't end is because roughly 10 to 15% of people had no conscience, not 20 to 25%. That's the difference in margin. If a few percentage points more were willing to simply say, I can afford this house payment and I'm not going to pay it, if a few more people were willing to say it than did, then there wouldn't have been any amount of government intervention that would have staved the downfall of what was going to happen. We just somehow, some way, had enough, and I admit it was the most flawed level we ever got to as a society, but we somehow, some way had enough people that said, I don't know if my house is underwater or not. I don't know if interest rates have gone up or not. All I know is I signed these papers, I can afford it, I'm making my payment. But if you believe that the housing crisis came about because too many people couldn't afford their payment anymore, I promise you, you are not reading any of the data available. It is patently false. The left knows it, the right knows it. People quit making payments when they realized that their house was not worth what they owed on it, and it was a question of convenience to walk away. People, what I just described, some have called a good business decision. Some have called, what is it, strategic default was a cute word for a little while. And so I understand the complexity in different people's lives. But the ability of the media to act, because we saw unemployment go up to 10%, and to correlate home defaults with unemployment is totally untrue. The vast majority of the people in that unemployment data were not people who were homeowners and then lost their job and then had to quit making a payment. They have it completely backwards. The bulk of people lost their jobs because they were in a construction-oriented industry or consumer-oriented industry, and because people quit making their payment, then those industries dried up and people lost work. By the way, the unemployment rate for people, college graduates in a certain class, is about 5%. Unemployment of people in their 20s, hardworking guys, blue-collar jobs, especially if you're in your 20s, it's 24, 25%. Those weren't people that had lost their home because they lost a job. They were people who didn't own a home. We've had 1 million people in the United States of America in 2008 and 2009 move back in with mom and dad. That were people who had moved out and come back home. Those were not the people who quit making their house payment. It was by and large people who could afford their house payment. Maybe the payment was stretching them. Maybe they shouldn't have taken the mortgage. Maybe they would have to sell the house at a loss. But my point being, whether there were assets in the bank to cover or at least adequate cash flow to make the payment, the vast majority of defaults fall into one of those categories. At its root, this crisis is a story of a society, not just elites, but everyone, living off a lifestyle they could not afford. It was a 10th commandment violation run amok. There's never been greater leverage on violation of a commandment than this one. Now, Dr. Morse is going to talk in more detail this afternoon about how it was specifically a crisis in the home that led to a crisis in housing. But I want to say that I believe the culprit is in the mirror in a lot of cases. And I don't necessarily mean that specifically, but metaphorically. And I came up with a great, sweet, family-friendly analogy. Drug dealers. We can blame drug dealers for selling drug users the drugs. I would be an anti-drug dealer guy, in case you're curious. But that does not come close to addressing why people do drugs, why they're addicted, why they will not stop. Our entire conversation about the financial crisis attempts to deal with the support actors and not the underlying user. Forget the dealers and peddlers, unseemly as they may be for a moment, and let's be honest and principled enough to admit that we have drug abuse because we have people on drugs. Ultimately, there was no product for Wall Street to lever if there were not people trying to live outside of their means. If somebody was making a responsible home purchase, making their payment, it's so overly simplistic, but of course we know there'd be no crisis. Government as social policy changed a lot of the conversation. Fannie and Freddie enabled a lot of it. The Federal Reserve put octane on it. Wall Street loved it all and just sat there at the slop eating off of it. But the problem that we miss in the conversation is none of that is relevant if there wasn't somebody there participating in the underlying action themselves. So even though I've gone through an awful lot of ground quickly, I want to provide that larger overview of what I think caused the crisis and take a real quick look at the solutions we're now seeing coming out of D.C. and then provide a couple quick ideas that I think, and some of which I think may be reasonably novel. First of all, this Dodd-Frank bill I alluded to earlier. There's no reason for me to be political about this. It's just a complete piece of garbage legislation. That's not political whatsoever. It's one of the most insulting things to the American people's intelligence I've ever seen. Raise your hand if you think Wall Street excesses played some role in causing the crisis. I mean, is that easy enough for a lot of you? Raise your hand if you think that debit card fees played a role in causing the crisis. So what we have right now in this country is the largest financial firms, every one of which, from number 1 to number 10, dramatically bigger than they were 2, 3, 4, 5 years ago. So not one single thing about their horrific too big to fail rhetoric has been changed or addressed. But the banks are no longer allowed to charge people who overdraft their debit card a fee for doing so. So I'm glad we got that covered. It is sort of funny, but if you think about it, it ought to be infuriating, because it isn't just that it's politicians using one thing to kind of slip in another. They do that all the time. But this is particularly egregious. This was hailed as the most landmark legislation since the Great Depression. And all these Barney Franks and Chris Dodds who helped cause the crisis, sitting there patting themselves on the back for signing this stupid bill that does nothing whatsoever to address the fundamental issue: monetary policy, government intervention, price discovery, and, of course, the societal moral climate we lived in, which government, thank God, doesn't attempt to legislate that. We need a massive expanded oversight from the same government that regulated Citi and AIG and that quasi-operated Fannie and Freddie. And by the way, how are they doing with their own money? $15 trillion of national debt, a credit card with north of $1 trillion being added per year. We need them overseeing the financial firms like I need a hole in the head. We didn't even get that. We got ATM fee regulation. Dodd-Frank is the classic case of politicians doing nothing while looking like they're doing something, and in fact doing something negative. It is posturing, and I think we need to put an end to it. And then here's the other area I referred to earlier. I talked, I think at the end of my last speech, maybe beginning of this speech, about interest rates right now still being at 0%. And clearly, I can promise you, it would not be a very well-received political move for a Fed to begin tightening, raising interest rates. But this is, in a lot of ways, analogous for any of you that have ever dealt with a loved one with a drinking or drug problem, that there is a real legitimate sense that you cannot be hungover if you keep yourself drunk. We call it hair of the dog. You wake up, you feel horrible, you start drinking again, you're going to feel real good. And you do it again and again, and it can work for a little while, but there is a problem. At some point, you're going to stop. And that hangover you were deferring from day 1 on day 4 is going to hurt so bad you can't even stomach it. We have a hair of the dog monetary policy in this country. I don't know when, and the Ron Paul Austrian guys get themselves in a lot of trouble by daring to predict when, and then wrong about it all the time, so then they look like a bunch of Chicken Littles. We don't have to tell you exactly when. At some point, this will catch up with us. You will have to take your hangover as a society, and it will be ugly. It is obviously inflationary. We are creating money slosh going on right now that is similar to the money slosh we had to cause the crisis. The only difference is this time the banks aren't playing. They're not touching the money, so we're not getting all this kind of stimulation and activity. But that's not for lack of trying. This is not me being unfair to Chairman Bernanke, who I think, by the way, is a very sincere and kind guy. I don't villainize him. I just disagree with him ideologically. I believe he has a wrong viewpoint. He thinks he can kind of manipulate supply of money and demand of money, and I don't think he can. But they're trying to. There's no reason to cure the crisis with what was the cause of the crisis. So what would I do? What is the path forward on the economic side? And then I'm going to get on to introduce a far better speaker than I. Number one, I'll say it quickly because I kind of already did in identifying and diagnosing the problem. An end to the protected class of creditor we have created, and more importantly, the end to the reason we've created this protected class. We have got to wean ourselves off of society's addiction to low interest rates. The reason we don't do this is because low interest rates means more stimulated activity, and everybody wants that stimulated activity, but it's a sham. Let proper risk return to the market, and then the proper pricing of risk will resume. Price discovery is so flawed right now, we have to expect booms and busts to continue. Number two, I think this one is a little bit outside the box. But this is probably the most anti-Wall Street investment bank thing I'm going to say, because I mean it wholeheartedly. There's nothing I'd love more than for Wall Street to return to the client business and away from the sort of balance sheet business. The things that they're doing with their own money that are not client-centric versus the things they could do that I think they're very good at doing, which is generally advising people on capital transactions, whether it be in the investment banking world or wealth management world. So that doesn't do us a lot of good because somebody's going to have to be involved in this. Well, guess what? Society and the free market found this proposed alternative actor for us. And that actor is one that Congress has decided to declare war against. But let's have more capital markets wallet share going to independent hedge funds. Let me read a review from the masterful book, More Money Than God, by Sebastian Mallaby. All readers of my financial crisis series should want the... Oh, no, and by the way, I'm sorry, this is not an excerpt from his book. It's an excerpt from my review of his book. All readers of my financial crisis series should want the same thing I do. A future investing landscape that rewards good risk-taking and punishes bad risk-taking. A future landscape that's prepared to intelligently allocate capital in what will certainly be a challenging period. The aftermath to the crisis has been to mistakenly assume that government regulation will accomplish all of that. But as Mallaby's tremendous book shows, this is not the case at all. Best-of-breed investment managers prudently seeking out inefficiencies in a marketplace that's chock full of them is an ideal solution to the investing need of the hour. In the hedge fund industry, we have just that. No, these men are not all angels, but of course, neither are the regulators, politicians, or big banks either. What they are, though, is the best innovation a market system has come up with to date for providing superior risk-adjusted investment strategies to an institutional and retail investor population without the backstop of the American taxpayer. How many hedge funds have received dollars from TARP? But Congress right now in a full-blown war against those that frankly represent a friendly, partial remedy to the problem. More private money, they can be good at what they're doing, they can be bad at what they're doing. Let them lever up whatever they want, but buyer beware. Who could possibly have a problem with that? No moral hazard. And yet instead, we've decided that regulating the bejeebers out of these guys. I'm using the word hedge fund, by the way. It's a bit misleading of a term. I'm just simply referring to independent asset managers, those that go out and raise money. By the way, what has Congress done about this? Said that you have to be a special class of person to even invest with one. You have to have $1 million or $2 million to even be eligible, things like that. Silly stuff. Okay. The reason war on that type of a solution, it's class warfare, pure and simple. Playing into the class envy. It's not a serious attempt to right a wrong. It's sacrificing the moving of the ball in the right direction so they can appear to be doing something. Any paradigm that's putting more control of capital markets in the hands of innovative, bright asset managers who will make and lose money is a good thing. C, this third point here, getting to that Fannie Freddie issue, Andrew did a great job addressing a lot of this. Public-private partnerships are not a solution, but ending them is. Okay? We hear all this rhetoric right now. Public-private partnerships, somehow I'm positive it's been tested and group tested or group, the surveys and everything else to determine that it's apparently somewhat benign. People like the idea of it. The greatest example of a public-private partnership in history is Fannie Mae, Freddie Mac. It was an abject failure. You cannot blame China or bondholders or society at large for believing that buying Fannie Freddie debt was a good deal compared to U.S. Treasuries, because it was. Yet it's clear that the mix of democracy and capitalism, my friend Walter Russell Mead says, is a dangerous, if necessary, brew, But after decades in which we failed to think the cost and risk through, we're now suffering the consequences of policies that create dangerously perverse incentives in both political and economic spheres, reducing damaging but popular forms of state intervention in the economy while ensuring that the state retains the authority and ability to provide an effective legal framework without which no modern economy could flourish, is fiendishly difficult, but it's the delicate task which Americans alike, Americans and Europeans, he says, must now undertake. The notion that having a government hybrid with private enterprise will lead to any other conclusion than what Fannie Freddie led to, I think is dangerous. Number 4, I return to sound thinking regarding housing. We're not there yet. People continue to lament the weak housing market. But my friends, housing is only weak if you're trying to sell one. Buyers like weak housing. The reality is that this paradigm only exists in national conversation about housing. An equilibrium in a price where a buyer thinks they're getting a good deal and a seller thinks they're getting a good deal is the cornerstone of a society of voluntary exchange. By definition, in a system of voluntary exchange, there's no bad deals. The buyer thinks they're getting a good deal, the seller thinks they're getting a good deal, and then they walk away. And they find a price in the middle, and the market does its thing. We right now say, no, the prices are just too low. We got to do something to get them back up. We only do that with housing. We don't do it with bread. We don't do it at the grocery store. But it's ridiculous. And the real reason they're doing it is not because it helps the homeowner. The homeowner holding his home to live in it doesn't need the value to go up unless they're borrowing money out of it, unless the bank has an asset on their balance sheet that they need to mark up. That's the real political story of strengthening the housing market. It's about financial leverage. It's about the underlying debt. The reality is we need to resume talking about housing the way we used to. If you want to buy a home as an investment, you figure out what you're going to rent it for, discount the cash flows to a net present value. It's either a good or a bad buy. It is not a trading card. It's not a commodity to split around. But with low interest rates where you never even need to get any rent in, never even need to make a payment and whatnot, it's skewed price discovery. Now, 3-4 years later, from the worst housing collapse in world history, I still hear people talk about, wow, if we could just get housing to turn around a little bit. To what? To get back on the wagon? To start drinking those cocktails again? Awful idea. Vote yourself a home has been our national motto for the last 50 years. Today, Americans are as addicted to the home mortgage deduction, and even less justifiable deductions for second mortgages and home equity loans, as the Greeks are to early retirement and government employment. Political popularity makes these policies hard to change, but they're damaging and destructive. We need to quit treating residential real estate like a sacred cow. It's a political agenda behind it. Quickly, I'm going to throw out another point and I'll move on, but an end to non-recourse financing. If you're from a state that doesn't have it, then you're probably from a state that didn't have a housing market go down as much. But to the extent that a lot of states, including, tell me what these states might have in common. California, Nevada, Arizona, Florida, the states that were by far hit the most of the housing market, where you can say, I have $4 million in my bank account, I'm earning $300,000 a year, I have a bunch of stocks, I have 3 other homes, but I owe $1 million on this one home, it's only worth $700,000, I'm going to walk away. And the only thing the bank can do is take that house back. You can expect more moral hazard. The reality is this non-recourse financing stuff is just so ridiculous and led to the bubble up being bigger and the bust being much worse. Finally, no policy infallibly ends booms and busts, and it's statist, by the way, to believe that the government can do something or refrain from doing something that will usher in utopia. This is where I will point out a little bit of a critical philosophical difference with some of the libertarian and Austrian friends of mine. I don't just believe that all these statist interventionists are wrong. I think that they're wrong, too, that by the government doing the opposite of it, it's going to create utopia either. I accept what Thomas Sowell called a constrained vision. I don't think utopia is coming. I believe that we will live in an imperfect world, but we will create the preconditions most optimal for human flourishing to the extent that we operate off a voluntary exchange of goods and services, a free and virtuous society. And if permeating that society with the vision for free and virtuous society is what we have to do now to avoid another financial crisis, then by all means, let's do it. But had the free and virtuous society been permeated prior to 2008, there would have been no 2008. I cannot think of another group that can honestly say that. The true, pure, blue, Ayn Randian, free market conservatives out there cannot say with a straight face that their worldview would have avoided the financial crisis. But I know that my friends in Grand Rapids, Michigan can say it. Those promoting a free and virtuous society, that if you hold on to all parts of this, avoid all flaws that we alluded to, that only then do you have a comprehensive economic and moral worldview that would not only have avoided the last crisis, but keep us from the next one as well. With that, I will conclude. Thank you very much for your bearing with me on a long talk. And then what I'm going to do is let Chris move to the next track here for the purposes of